Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please don't hold that against me. Welcome to it, folks. We've got an interesting topic for you today. And before we jump into it, I just wanted to remind everyone, if you'd like to get in contact with me, suggest any topics for the show that you're keenly interested in, or start your search for a new home, or get an instant valuation on the home you currently own, feel free to head on over to soldbyrobert.com. I have all those tools right on the front page above the fold, so you don't have to go searching for it. Feel free to take advantage of that whenever you like. And of course, I serve Silicon Valley is my home turf. So feel free to get in touch with me if you have any questions about that marketplace or would like to discuss your options. Now, I wanted to take a little bit of time today to talk about sort of the sentiment, right? The psychology of folks right now with some numbers from March that come from Realtor.com relating to what buyers and sellers are thinking. And I'm also going to segue a little bit into a chat about loans, interest rates, and what thoughts should you keep bouncing around in your head as you're moving forward with your potential purchase of a home? Because I think we're at a time for buyers that's interesting. If you are someone who also watches my market report videos on YouTube, you've probably seen this as a theme in the last couple of months. But we have definitely got a interesting situation, and let's just break it all down. But let's start with some of the home purchase sentiment data that the folks on Realtor.com just shared, and what they're doing is sharing with us some data from the Fannie Mae Home Purchase Sentiment Index, right? So this is from Fannie Mae. And one of the first things is the index improved by 3.3 points in March. Well, let's figure out what that actually means. The index is down 11.9 points compared to the same time last year. So month to month, there's an increase, but year over year, there is a decrease. And let's also remember that we are in a pivotal time in a month to month world, right? There's always big changes between February and March. February tends to be a little suppressed in a lot of different ways. And then March is usually the time when we start to see things starting to kick off. More people listing their homes, sales picking up. So keep that in mind as we go through this, because some of these changes are small enough that I think it's a natural part of the season of the year, right? And March is also a critical month for us, because remember, March was the month when we started to see interest rates increase in the real estate market, which really depressed buyers out there trying to make a purchase. So keep that in mind. March and April are going to be super interesting. April's going to be really interesting because we were fully into the whole reality of new interest rates. And also April is the first month where you will see deals closing that had offers accepted in March, right? So you'll see a little bit of it in March, but I think you'll start to see the bulk of it in April in terms of that difference, that borderline between the crazy seller's market that we had before interest rates went up and what we ended up with after that point, right? So it kind of straddles the March-April timeframe. And we'll take a look at that, obviously, as we get through those months with the market reports that I do on a regular basis. But let's go ahead and try to because part of the goal here is to figure out where we're going. What are the thought processes? And so much of this real estate world right now is psychology based, right? What people do things based on what their beliefs are. Whether or not those beliefs are rational or not, whatever the common belief is tends to indicate the tide or direction that things are moving in. All right. So if we look at home buying sentiment, they indicate it is remaining unchanged. 20% of respondents believe it is a good time to buy a home, while 79% think it is a bad time. These are obviously national numbers, so it's going to change from market to market. But anecdotally, locally, I have definitely seen an uptick in the number of buyers that are generating searches for properties. And by active buyers, I mean people who, when they get an update relating to a property, they go and check it out immediately. Now, I have some buyers that are far more casual. Maybe they only get their updates once a week or even once a month. I would not consider those folks super active buyers. But the folks who are instant update folks, and those are the folks who, as soon as a listing comes on the market, it gets sent to them via email or text, and then they go and they view it, right? That is an active buyer in my book. So, and I've seen an uptick in those people locally, ranging from Gilroy all the way up into the heart of Santa Clara County and Sunnyvale, San Jose, Cupertino. All of those areas are definitely seeing an uptick in that kind of activity. Not substantial, but it is an uptick from what we've seen over the past few months. And I'm not comparing it to March of last year, because March of last year obviously was a very different time in terms of what challenges buyers were facing. Next, let's see. They continue to cite unfavorable mortgage rates as a primary contributor to low sentiment. The survey highlights that 51% of respondents expected mortgage rates to go up over the next 12 months, while only 12% expect them to go down. Now, that is kind of interesting, right? So in the mind of buyers, according to this data, first, the majority of them think it's a bad time to buy, but they also all think that the rates will go up over the next 12 months. Well, what picture does that paint? If they're not willing to buy today under current interest rates and they expect interest rates to go up, and 51% of them do, they're not expecting to jump into the buyer's seat for a year at least, right? Because if they were expecting interest rates to go up, you would expect those folks to want to jump in on rates as they are right now instead of later when they go up more. So that's interesting. And another part of it, again, from anecdotal, me locally talking to buyers, there's also concern on the part of buyers that we haven't hit the bottom of this market yet, that there are better deals to be had in coming months. And I'm not sure that's true. We are in a very weird position. If you watch some of my most recent market analysis videos, you know I've brought up months of inventory. Well, across the board here in at least the southern Silicon Valley area, we have under 2 months worth of inventory. We aren't in a balanced market till we're at least at 4 to 5 months worth of inventory. So at this low number of months of inventory, if you were to just look at that, you would assume we're in a seller's market. And clearly we are not, given what's happening right now. But the reason why I bring that up is, given that scenario, all it takes to tip this back into a seller's market is for some external influence to push more buyers into the market by just a little. Because suddenly that inventory drops very quickly. With just a little uptick in buyers, we suddenly see that very low months of inventory get sold off, and suddenly we are back in multiple offer territory, which I would rather not see. I'd much rather see a balanced market, but we are so on the edge right now. If something pushes that market of buyers into being more interested in buying, the transition from buyer's market to seller's market, given the data we're seeing right now locally, would be a very rapid change. But there's also something else to take in mind here, and this is something I think I wanted to close today's show with, but let's go ahead and just bring it up so you guys are wrapping your head around it as we go. And I'm not trying to do this from the standpoint of the guy who has a vested interest in you wanting to buy a house. I'm honestly trying to put this out there as something to at least consider. If you do believe interest rates are going to go up, it would make more sense to buy now. I'm not even sure that's the argument to come at when talking about this. My feeling is, because interest rates are where they are and because buyer interest is where it is, I believe that from a getting the best deal on the house, let's talk independently of interest rates for a second. If you want to talk about, just because you can use that interest rate as a negotiation tool to get a better price on a house. You can say, well, gosh, if I go out there and I get a loan on this house, your $1.2 million house is a very expensive monthly support thing. And sellers can't ignore that their ability to get their home sold is at least a little bit influenced by interest rates, right? And right now it's very much influenced by interest rates. Use that as a negotiation tactic. Get the best possible price through some negotiation through your real estate person with the other real estate person on the listing side, and get that deal right where you need it to be for you to feel better about that deal. My point is, this is a great opportunity to get deals on the purchase price of the home. If you wait for interest rates to get better, more buyers are going to come into the marketplace, and suddenly your leverage to negotiate that lower price, which will stick forever, right? Whatever purchase price you negotiate, In a year and if you decide to buy it, well, suddenly you're not asked to pay more, right? On that purchase price, you get what you get. Interest rates are a different story. Right now, yes, interest rates may be high. I get it. But let's take a couple of things into account. Right now, interest rates are high, and let's take it away from real estate. Let's take a look at it from the standpoint of why are rates where they are. Well, right now, we are trying to fight inflation. And when you fight inflation, the key tool that the government uses is increasing interest rates. That's why interest rates are raised. That's why interest rates are higher. Now, as we've talked about on this show, there is no direct relationship between the prime rate and your interest rates you pay on a mortgage. It's more about the 10-year treasury. We've talked about that, and so much of it is psychological because remember, we've also had times where interest rates went up on the prime rate, but mortgage lending actually went down in interest rate. So kind of keep that in mind. But there's also a psychological aspect to it, particularly when the next thing that we need to fight is recession, economic slowdown, right? That's another term. That's a buzzword. I tweeted something earlier today where they were using the term economic slowdown. Well, that's a word that you would use to refer to a recession. If companies are cutting R&D, if they're reducing manufacturing, if they're reducing their footprint from a standpoint of how much commercial real estate they control to do their business, if you're Facebook and you're firing a whole bunch of people, including HR and recruiters and all these other things, and if you're Google and you're firing letting a lot of people go, that is all a thing that ends up as a recessionary thing. And here's what's important about understanding that. If you believe that we are going to head into a recession or that we're already at the beginnings of one, once the government has control over inflation by raising rates, what does the government has as its primary tool to fight recession? Lowering interest rates. Why? They want to entice businesses to borrow money to invest in infrastructure, in R&D, in expansion. And you do that by lowering the prime rate. So if all that's true and you believe all these other external influences are actually a thing, and historically they always have been, if you go back and you look, it's always been the case when these things happen, then eventually interest rates for mortgage loans are going to go down. And it wouldn't surprise me if we see big drops in interest rates on mortgages. It wouldn't surprise me if we end up sub 4% again, 4%, 3.5%. It wouldn't surprise me if for a window of time, we get back to those kinds of numbers because the recessionary influences that are currently floating around, and don't take my word for it, I would strongly suggest you go and Google it or search it on YouTube. Look for some folks who've been right in the past. Peter Schiff is a good example of a guy who had it exactly right last time when we hit that downturn in 2007. People, and again, I know for my longtime listeners, this is like a broken record, but Peter Schiff was one of those guys where before everything caught on fire, he would be on these financial talking head shows and they would literally laugh at him for suggesting that the real estate market was going to take a dump. And sure enough, 10 months later, a year later, a year and a half later, we are where he said we would be. And everybody is shutting up and listening to Peter Schiff. Is he always right? No. Is he very strongly like a gold guy? Absolutely. And that always carries a little bit of a stigma, I think, with it. But when you're right, you're right. And that earns a certain level of trust. And he's definitely talking about recession. And an awful lot of others are talking about recession. And then others are just using code words for recession, right? Like we talked about earlier. But again, the primary strategy is reducing prime rates, interest rates, when a recession is what you're trying to fight. So if that does happen, you are going to have an opportunity within the next year or 2 years or 3 years to refinance that fixed loan down to a lower rate. Now, I'm not going to suggest, wow, Robert said I should do this. No, that's absolutely not what I want you to do. I want you to look at the circumstances, see what you believe, what you think is the truth, and what is the most likely outcome. But if I were a buyer and I was looking to buy a property, I would absolutely milk the current scenario for every penny it's worth to get the best possible deal on a property. And if I was in the market, I'd be looking at duplexes because I think that's the super awesome way to go. But I would be looking at duplexes. I'd be negotiating down those prices, and the arguments of interest rates absolutely carry a lot of weight on that side because duplexes and multifamilies is all math. It's not I love the decor or any of these other things. For those investment style properties, it's all about the math. So you can definitely have a situation where you're negotiating, and I'm seeing more and more of these properties come on the market that stay longer. So that increases your negotiation powers as well. And that's even true of single family residential. But the point being, at some point, you'll be able to reduce that interest rate, reducing your monthly costs, but you have this locked in lower price that you benefited from. And I have no question in my mind that at some point, of course, everything's true with a long enough timeline, right? But in a relatively short timeline, in less than 5 years, I am willing to bet that we are going to see interest rates drop for lending, specifically because of the whole fight against recession that is likely to be coming within the next 12 to 18 months. So you're presented with an opportunity, a window of time where you may have to pay more than you want, but you should make sure you're paying what you can manage, right? Always be ready for the worst case scenario, which is interest rates don't go down and you're stuck with that loan. Be ready to make that payment, but with the understanding in your head that you've done it so that you could lock in this lower purchase price and in anticipation of a move from the Fed that will result in lower interest rates for you on a refinance of your property. So, and I think as I said, I meant this to be the punchline at the end of the show, but that was really one of the key points I wanted y'all to take away. And I'd love to hear your comments on it. What do you think? If you're watching this on YouTube, comment below. If you're listening to the podcast, feel free to head over to soldbyrobert.com. The podcast should be right there, and you can comment right there on the page, the entity page for this podcast. Happy to do it there. Or if you'd like to privately comment to me, you can send me a message at soldbyrobert.com as well to just discuss it back and forth. And I know there's 2 or 3 of you that absolutely will have thoughts on this one, so I'm anxious to hear what you guys have to say. Okay, so as we go through the rest of these numbers, because remember, we want to try to calibrate ourselves here. Existing median home sale price posted the first annual decline in over a decade in February. In February, that may be true nationally. We have been seeing this as a thing in the last few months in our local market as well. In fact, we have, and they talk about median, the average sales price is down in Santa Clara County 10.2% as of February of 2023. Last year it was 1.7 million. This year it's 1.5. And what's interesting is in the month of February, one of the communities I track with the lowest decline from last year was Gilroy. I think primarily because this market was a little bit more calibrated earlier to this new reality of lower prices. But I think Gilroy is also getting a lot more attention from buyers than in past years, because folks who were looking in San Jose or other northern communities they had to reduce the amount that they were going to borrow because of interest rates, but didn't want to skimp on the house they were getting. So I think some of those folks moved to Gilroy. And anecdotally, I am seeing more people asking about Gilroy than in past years. So just as another little data point. Okay, percentage of respondents who say home prices will go up in the next 12 months, increasing from 30 to 32%. So in general, people think home prices are going to go up. That's an interesting perception. I think in many areas that's not true. Maybe that's true nationally. Here locally, I honestly don't think that that's true. That 12 months is a big slice of time. We may see things go up in the hot months of this year, but I think overall from the year before, everything will be down. Home seller sentiment improves. Respondents who said it was a good time to sell a home increased from 54 to 58%. Interesting that we're not seeing that kind of increase locally from sellers. I have not seen an uptick in the number of sellers asking about listing their homes. I'm getting month to month, I'm getting the same number on average asking about selling their home, wanting to get more information about what their home might be worth. But when they talk about why they don't move forward or what they're concerned about, the thing that they tend to mention most is what do they do, right? And unless you're at a stage in life where you're relocating, where you're moving out of the area, they're concerned about finding another home that they will enjoy as much as the one that they're in, or they're just not in a point where their life is changing to the point where they are thinking they need to get a smaller home or a larger home or anything like that. So it's also a concern that they are worried that they won't get the maximum they can for the home right now. They believe that they've sort of missed an opportunity and are sort of waiting for that opportunity to come back around. These are sort of the casual conversations I've been having with folks who are talking about potentially listing their homes. Okay, percentage who say it is a bad time to sell decreased from 44 to 40%. We'll see how that goes locally. We'll see if the conversations I have with folks change as we move through the year. But right now, I'm not seeing that as much reflected locally. As of March, newly listed homes lagged behind all previous years in terms of new listings. It's down across the board. Santa Clara County was down 37% from the same time last year. Last year, they had over 1,500 homes listed in February. This year in February, 979. So our local market is absolutely reflecting that. The report shows that the percentage of respondents who say they are not concerned about losing their job in the next 12 months increased from 73 to 78%, while the percentage who say they are concerned decreased from 24 to 21. Given that net increase in confidence about continuing employment, that's another surprise as to why folks wouldn't want to jump in as buyers. It's less of an influence relating to sellers. But if you're a buyer who believes that, and again, this is a national number. I'd love to see what this is in Silicon Valley, particularly since we've been at the epicenter of layoffs for some of the big local companies like Facebook, like Google, like Apple, like, whoever else, Intel, whoever else is out there. It'd be interesting to see how that plays out locally. But my guess is this level of employment confidence isn't reflected by the folks we're seeing here in our local community. All right, so that hits all the data. And then this was the part where I was going to talk to you so much about what do you think about getting a loan now and then sort of anticipating that down the road we're going to see interest rates reduce. Again, I would love to hear from you on this one. My suggestion would be move forward now. Now, of course, we're starting to head into the market time when it's going to be a little bit hotter, and that's a double-edged sword. One, buyers tend to become more active, but you tend to also get more homes listed. Next, we should see this should be the month when homes start to get really listed at a more aggressive scale, at least compared to the month previous, maybe not as much as the year previous, but that would give you bigger selections, right? So you can potentially find sort of the best of the best in terms of homes that would be put onto the market or that fit your needs the most. So keep all of that in mind. I still think it represents a great opportunity for buyers. I think that the sellers market is totally dependent on where you are in a community. I can't tell you what's going to happen to your house in San Jose without knowing where it is in San Jose. I can't tell you what's going to happen with your Morgan Hill home without knowing where in Morgan Hill. Because again, there are still some areas in all of these communities that homes are selling right away. And if they tend to be the best homes in those areas or offer the best features in those different areas. Same is even true in Gilroy, right? Northwest Gilroy is an area that folks really like. It's the area right around Christopher High School, for instance, is always in demand. So it really depends on where your property is located. I can't really give you a generic idea of what's going to happen or potentially going to happen with your home in today's market unless I know right where it is. So, all right, folks. As always, the goal is to leave you with more information on the table than I take up with your time. I absolutely hope we've achieved that this time. Thanks again for listening. I will talk to you all next time.